Welcome back to another episode of Moving to the DMV. In today's video, I'm going to be talking about real estate investment. I have had a lot of people come up to me and say, "Hey, Kay, what do you know about real estate investment? How should we get into it?" Well, there are three main things that you need to be worried about when it comes to real estate investment. The first thing is estimating your cash flow. Second is estimating your rental income. And the third thing is cash deals. So let's get into number one. Number one, estimating your cash flow. Analyzing the rental market is very, very important when it comes to you figuring out how much money that property is going to make. Now, you need to be able to research the current rental rates in that area and you can check online platforms. My biggest advice is if you know the location, if you have a general idea of the area where you want to invest in, you want to be able to talk to a local real estate agent. Nobody's going to be able to provide you better value than somebody that has lived in that neighborhood and worked in that neighborhood for quite some time. If you're looking for online platforms, there's Zillow, there's airdna.co, there's Property Shark, Rentometer, and if you look for it hard enough, Excel has some cheat sheets that if you go on Excel, you could plug in your numbers and figure out what exactly that property is worth to you. Number two in this is calculating your operating expenses. Now, it doesn't matter if you are doing an investment property or if you are doing a first time home buy. You need to be able to consider your property taxes, your insurance, maintenance costs, and anything else associated with the property. Now, if you're doing investment property, you also need to potentially think about property management fees. And here's the number one thing that I tell people that are looking into rental properties: think about vacancies. It doesn't matter whether you have a tenant or not. The bank is not going to care. They're going to ask for their money on the first of the month. Every time, every month, they're going to say, "Hey, where's our mortgage payment?" And if you don't have the ability to count for vacancies, it's going to tie up a lot of your cash. So make sure you have the financial responsibility to take care of that. Third thing is determining what your net operating income is going to be, your NO. Subtract your operating expenses from any potential rental income. And this gives you the property's net operating income. This ties in beautifully with evaluating your cash flow. This is exactly what we were trying to do this whole time. You want to compare your NOI with the mortgage payment and any other financing costs associated with the property. If you have positive cash flow, it means that you made a profitable investment. That's it. Number two, you want to estimate your rental income. This goes back into the first thing that I said: market research. You want to study the local rental market thoroughly. And this is not just looking for properties. You want to look for similar properties, but you also want to look for what they are going for as far as rental rates. If you have the exact same townhouse as your neighbor and they're both renting out and your rent is much higher because you think you can make more money, let me tell you, it's going to sit there vacant and you're going to look like a scummy landlord, and you don't want that to happen. So you want to be able to use the comparables to support the rent that you are asking for, and if you can afford it, right? So look for similar properties, look at their rental rates. Again, you want to consult an expert. Reach out to a property management company in that area or a local real estate agent. They can give you insights into rental demand. What is going on in that neighborhood? What is happening? What kind of properties are going faster than others as far as rentals are concerned? Is it condos? Is it townhouses? Is it single family homes? You want to know this information because it gives you the appropriate and real time insight on how you should price your month to month rent to be seen as a favorable landlord. That's what you want at the end of the day. You want to build a relationship with your tenant, right? You can use online tools. Find rental estimate tools based on the property type and the location. That's the two things. I know I mentioned the tools that you can use, but you want to be able to make sure that they show what kind of property you're using and the type of location. Like, where is the property and is it similar to what you're looking for as far as an investment? This can at least provide you a solid, useful starting point. After that, you can get into the weeds about it. You can get kind of more in detail and discuss what is best for you and whoever you're working with at the time. And of course, you want to have regular updates. If you're not staying informed about market trends, if you are not adjusting your rental income expectations accordingly, again, I'm gonna bring it back. I'm gonna keep it real with you guys. Don't be a scummy landlord. There are plenty of them out there already that are creating disastrous situations for their tenants. I don't want you to be one of them. If you can't afford to support a market, if you can't afford to have a rental property in a situation where you think it'll be beneficial to other people in the area, maybe you shouldn't get into it. It's not sustainable. Don't do it. It's simple. We're going to get into section number 3, cash deals. Cash is always going to be king. That is a tried and true statement for as long as we have been alive. So let me get into the pros. The pros of a cash deal: faster transactions, no interest payments, and it gives you strong negotiating power. Now, what that means is faster transactions in the sense that if you go for a conventional loan or an investment loan, it takes maybe 30 to 45 days to close on that loan. If you're using cash, it'll take maybe 10 to 14 days. So anybody that is looking to make an investment, if you use cash, it's going to be seen as way more favorable. And this goes into no interest payments. If you don't have to go get a loan, that means you're not paying interest. And this potentially increases your overall returns for your investment, which is what you want. You want that ROI. You're going to have much better negotiating power. Cash buyers always have an advantage. If you look at somebody that is having a conventional loan, I've seen it oftentimes when somebody has a cash deal and it's a little bit less than what they're asking for or what the price might be. That's going to be favored more than a conventional loan that is going way above and beyond what the seller might be asking for. There is an advantage to using cash. Now, let's get into the cons, because there's always a downside. There's always two sides, right? Now I'm going to talk about cons of a cash deal. There are also three. It is opportunity cost, lost leverage, and whatever the tax implications might be. Opportunity cost is you're tying up the cash that you could be using in another potentially lucrative venture. Say you have $500,000 and you use all that cash to buy one property. That's $500,000 that is sitting in a tangible asset where you can't touch that money for an X amount of time. Where if you had split that money or if you had used it somewhere else, it could have potentially made you more money a lot faster. Again, I'm not a financial advisor, just a real estate guy. So just make sure you are knowledgeable before putting a large sum of money in one thing. It also makes you lose a little bit of leverage. Pulling money out, like if you're pulling out a bunch of cash, may reduce the leverage from financing if you need to finance a property as opposed to buying it all cash. The advantages of financing a property is that you don't have to worry about using up or tying up that cash in one spot for a large period of time. And Uncle Sam is always knocking on that door. You want to know what the tax implications are. I'm just a house guy, I'm not a tax guy. So consult a tax professional to understand what your consequences might be of using cash to buy a property, especially an investment property, as opposed to using any sort of financing. There you have it, folks. Those are the 3 things that I know about real estate investment. It's quick, it's dirty, it's just something that I put together. Remember, you need to educate yourself before making any sort of real estate decision, not just investment. I want you to understand these things. These are all very important, crucial details for a successful real estate journey, which is what I'm here for. I am your guide, I am your light in the dark. So subscribe to the channel. I appreciate you. And don't forget, I do have all this information available in a PDF that you can download in the description of this video. Thank you.